Hi everyone, welcome to our channel Brilliance. In this video we are going to see the basics of mutual fund. Before starting this video, I will tell you the channel disclaimer. We are not giving any buy or sell recommendation. This video is purely for educational purpose only. So we are not responsible for your financial losses. Okay, let's get the video started. Once you have decided if you are going to take a bet on Indian economic growth, what I mean here is if you are going to invest in Indian stock market, we have two options. One is direct stock investment and another one is mutual fund investment. Here we are going to understand the concept of mutual funds. Here you maybe can ask me, why should I go for mutual fund instead of direct stocks? Of course, you can invest in direct stock also, but I feel like it's like a cat on wall for many because it does need a much more time to analyze the particular stocks and make an investment towards it. So we can go for a easy option, that is mutual fund. Here we don't need to find a stock or we don't need to track their performance. Fund manager will do all these things and he will decide what to buy and what to sell. And these mutual funds are running by AMC company, that is asset management company. These mutual funds also have two categories. One is active mutual fund and another one is passive mutual fund. In active mutual fund, fund manager will do the investment and he will do the adjustment according to the market situation. But in the passive mutual fund, it's like a index fund. Here fund manager doesn't need to take any call on stock picking as we do invest in the index stocks. When you invest in mutual fund schemes, you won't get the direct stocks as units, but you will get the units of NAV, which means net asset value. Also they will charge you the fixed money to manage your investment, that's called expense ratio. It's not same for all the mutual fund schemes. Here we can see that two types of schemes. One is direct plan and another one is regular plan. In simple way, how we can understand this is, direct means we are investing without any agent. Regular means we are investing through some agents. If we choose a direct plan, you pay less expenses ratio. We can make an investment by two ways. One is invest in SIP method or lump sum investment. If you are asking me SIP or lump sum, it's absolutely based on your goal and your investment capability. But if you choose a systematic investment, you don't need to wait for a market to fall for an entry. But for a lump sum investment, we have to pick the right place for the investment. Now if you are thinking how the mutual funds are calculating their units, here it comes. If the investor invests 1000 rupees into their particular investment schemes, the fund NAV is 25 rupees, then you will get 40 units. We have covered the basic things of mutual funds. Now you may be thinking the mutual funds are managing by fund managers, so he will take care of my portfolio. So I can choose any mutual fund schemes? Absolutely no. Every mutual fund have different risk appetite. So as per your risk, as per your goal, you have to choose the scheme. Here also we have a diversification, like for the high risk investors there is equity mutual fund, for the low risk investors there is debt mutual fund. For the moderate people there is a mutual fund called hybrid mutual funds. Here I am sharing you how I diversified my mutual fund investment. I do invest in systematic manner and the diversification goes like my first 30% goes to index mutual fund and the next 30% goes to flexi cap mutual fund, and 50% for mid cap and 15% for small cap, and the balance 10% goes to momentum mutual fund. This is how I diversified my mutual fund investment. You can choose yours. Happy investing. Thank you for watching this video. We'll meet you in another informative video. Until then, keep rocking. Thank you.